Do you know one number that could make or break your chances of buying your dream home? It's called your debt to income ratio, or DTI. In this video, I'm going to unlock the secret behind it so you can find out exactly how much you can borrow for your next home. Whether you're looking at a conventional conforming loan, FHA, VA, or even a jumbo loan, understanding your DTI could be the key to securing the best mortgage deal. So stay with me because I'll also share some insider tips to help you improve your DTI for better loan options, and I have created a special workbook just for you. This free tool will let you input your own numbers, calculate your DTI, and even figure out how much home you can afford based on your monthly payment. Hey, I'm Yatin Karnik and welcome to Mastering Mortgages with Yatin, your go-to source for making smart home buying decisions. And if you're ready to take control of your mortgage and save thousands, you have come to the right place. Make sure to hit that subscribe button and click the notification bell so you never miss out a tip that could make a difference in your financial future. Now let's dive right in. So what exactly is debt to income ratio, also commonly referred to as the DTI, and why is everyone in the mortgage world talking about it? Simply put, DTI measures how much your monthly income goes towards paying your debts. Lenders love this number because it is what helps them decide how much they are willing to loan you and whether you are a safe bet. But here's the kicker. There are actually two types of DTI that matter. First, there is front-end DTI. This looks at how much your income goes towards your housing expense alone. Think mortgage payments, property taxes, homeowners insurance. Lenders use this to determine if you comfortably can handle your closing cost. And then we have the back-end DTI, which takes it a step further. This looks at all of your monthly debt payments, including your credit cards, car loans, student loans, and any other recurring obligations. This is more the important number for lenders because it gives a full picture of your financial situation. But here's where it gets really interesting. Different loan types like conventional conforming, FHA, VA, jumbo loans all have different DTI requirements. And those requirements can totally change the loan amounts and interest rates you qualify for. Let me break it down what these look like for each loan type. FHA loans, popular with first-time buyers, allow for a DTI up to 50% in some cases, but generally lenders aim for around 43%. This higher DTI flexibility is what makes FHA loans accessible for many buyers with lower credit scores or higher existing debt. The front-end DTI for FHA loans usually tops around 31%. VA loans, which are available to military service members and veterans, also offer some flexibility. While they technically don't have a hard cap on DTI, lenders generally prefer to see it at 41% or lower. Although applicants with higher DTI may still be approved with compensating factors like strong credit or additional savings, VA loans don't focus as much on front-end DTI, but it tends to hover around 28 to 31%. Conventional conforming loans typically cap DTI at 45%. However, for special programs like Fannie Mae's Home Ready or Freddie Mac's Home Possible, a DTI of up to 50% is allowed if you have a strong credit score or other compensating factors. These programs are designed to help low to moderate income buyers with more flexible requirements. The front-end DTI for conventional loans is usually 28 to 31%. For jumbo loans, which cover amounts beyond the conforming loan limit, the DTI is more stringent. Lenders usually require it to be 36% or less. Jumbo loans are riskier for lenders, so keeping a low DTI is crucial to getting approved, especially for those purchasing luxury homes, and front-end DTI usually needs to stay around 28 to 31%. Let's take an example to make this more concrete. Say you are making $100,000 a year. That works out to about $833 per month in gross income. If you are aiming to qualify for a loan with a back-end DTI of 43%, which is pretty standard for FHA and other loans, that means your total monthly debt obligation, including your mortgage payment, can't exceed 43% of 8,333, which is 3,583. Now, let's you assume already have some monthly debt obligations, for example, car payment of $600, student loans of $300, credit card minimums of $200. These add up to $1,100 in total monthly debt payments. Now, subtract debts to find mortgage monthly payment. Now, take that $1,100 and subtract it from $3,583 maximum allowed under 43 back and DTI. That leaves you with $2,483 for your mortgage payment. This $2,483 would need to cover the full mortgage payment, including principal, interest, property taxes, homeowners insurance, and any other costs like HOA. Depending on your down payment, interest rate, and loan term, this could get you a mortgage in the range of $350,000 to $4,000. If you found that example helpful, you are going to love this next part. Now, I'm going to show you how to use this tool with your own numbers, so you can see exactly how much home you can afford based on your financial situation. When you open the workbook, the first thing you'll see is a prompt to make a copy. This is important because it ensures that your information stays private and you can modify the sheet to fit your unique numbers. So go ahead and click on Make a Copy to get started. Once inside the workbook, you'll see a layout that's easy to follow. On the left, in the yellow highlighted boxes, you'll input your personal numbers. For example, start by entering your annual gross income in the top row. This will auto-calculate your monthly gross income just below it. Next, add your monthly debt payments, things like car payments, student loans, and credit card payments. As you enter those, the sheet will automatically calculate your total monthly debt. Then, input the current interest rate you are considering for your mortgage. With all this information, the workbook will calculate how much of your income can go towards a mortgage payment based on different loan types like FHA, VA, conventional, and jumbo loans. On the right, in the green highlighted column, you'll see the breakdown of each loan type. For example, FHA loans allow for a higher DTI, which could let you borrow more. You'll also see how much is left for your mortgage payment after accounting for your other debts. This gives you a good estimate of your loan amount as well. This workbook is a powerful tool that can help you make more informed decisions in your home buying process. So once you have plugged in your numbers, you'll have a clear picture of what loan might be best for you and how much you can afford. Now that you have seen how your DTI is calculated and how much you can borrow, let's talk about why this number is so important. Here's where your DTI directly affects how much house you can afford. The lower your DTI, the more confident lenders feel about loaning you a bigger amount and often at a lower interest rate. But if your DTI is high, they might limit the loan amount or charge higher interest, which costs you more in the long run. I have seen buyers miss out on their dream home because their DTI wasn't where it was needed to be. Don't let that happen to you. You want to keep your DTI low, not just to qualify, but to get a better interest rate, which could save you tens of thousands over the life of the loan. Now, if your DTI is too high, don't worry. I have got some actionable tips to help you bring it down and increase your chances of approval. Number one, pay off high interest debt first. One of the fastest way to improve your DTI is to pay off high interest rate debt, like credit card balances. Credit cards tend to have some of the highest interest rates and contribute heavily to your monthly obligations. Focus on paying down these balances first so to reduce your overall debt load. Actionable tip. You use the snowball method, which is to pay off the smallest balance first, or the avalanche method, that is to pay off the highest interest rate first to systematically reduce your debt. Second, refinance or consolidate loans if you have multiple loans. Consider consolidating them or refinancing for lower interest rate. Refinancing can lower your monthly payments, and debt consolidation can reduce the number of individual payments, helping you get your DTI under control. Actionable tip: look into balance transfer credit cards or a debt consolidation loan to combine multiple debts into a single payment with a potentially lower interest rate. Number 3, increase your income. Improving your DTI isn't just about lowering debt, it's also about increasing your income. Taking on a side hustle or picking up extra shifts at work can help you boost your monthly income, which reduces your DTI by expanding your overall earnings. Actionable tip: consider gig economy jobs like driving an Uber, freelance work, or online tutoring to generate extra income, or negotiate a raise with your employer if your role has expanded. Number 4, avoid taking on new debt while you're working to lower your DTI. It's important to avoid taking on any new debt. That means delaying major purchases like financing a car or taking out a personal loan until after you have secured your mortgage. New debt will only increase your DTI, making it harder to qualify for the loan. Actionable tip: delay purchases requiring credit and use cash or savings for necessary expenses to avoid increasing your DTI. Number 5, consider extending loan terms if you're struggling with high monthly payments. Another option is to extend the term of your current loans. By stretching out repayment period, your monthly payments will decrease, which can reduce your back-end DTI. This could be an option for car loans, student loans, or personal loans. Actionable tip: contact your lender to see if you can refinance or extend the term of your loan. For example, switching from a 5-year to a 7-year car loan could lower your monthly payments, thus reducing your DTI. Number 6, pay down small debts. Before applying, even small debts like medical bills, store credit card balances add to your DTI. By paying off these smaller balances in full, you can free up some of your monthly income, improving your DTI ratio before applying for a mortgage. Actionable tip: prioritize debts with low balances but relatively high monthly payments, as eliminating these can have a quick impact on your DTI. Small changes can make a big difference when it comes to qualifying for that mortgage you are aiming for. Whether it's paying off high interest debt or increasing your income, these steps can help you lower your DTI and secure the home you need. So whether you are a first-time buyer going for an FHA loan, or a veteran exploring VA benefits, someone looking at jumbo loan for a larger property, or considering a conventional conforming loan, your DTI is a critical piece of the puzzle. Don't let it be the thing that holds you back from your dream home. If you want to dive deeper into this topic, be sure to download the free workbook I have linked below. It will help you calculate your own DTI and give you an estimate of how much you can borrow for each loan type, including conventional conforming, FHA, VA, and jumbo. If you have any questions or need clarification, drop a comment below and I'm happy to help. I read every comment and I'd love to guide you through any challenges you're facing. And remember, if you found this video helpful, hit that like button, subscribe, and ring that notification bell so you never miss out a mortgage saving tip. Thanks for watching.